Welcome back. The South African Reserve Bank has cut rates by 25 basis points. This is the second consecutive rate cut and the final one for the year. With me to debrief and unpack this are Old Mutual's chief economist Johann Els and Matshego, senior economist at Nedbank. Gents, thanks so much for joining us again. As we kick off, right, was expected a 25 basis point cut. I guess what I want to find out here is what stuck out the most for you. Isaac, let's start off with you.
Sure. I think it was a bit more hawkish than I expected. I was not surprised by the fact that it was 25 basis points, but I had hoped that there would at least be a discussion of 50 basis points, because this could be the last. This could have been rather the last opportunity to go big, if I can put it that way. So, a bit of a disappointment, and also, the hawkishness on administered prices.
I was about to mention that. I was about to say, correct me if I'm wrong, but the governor did sound a bit hawkish. Johann, what have you made of today's statement?
Absolutely, I agree. I strongly believe it was a missed opportunity. I was surprised by the extent of the hawkishness in the statement. I expected somewhat more hawkish than the very dovish September statement. Yeah. If you take September, when they even discussed a 50 basis point cut, and now the governor said they didn't discuss that at all, where inflation actually surprised significantly to the downside relative to what we thought back in September will happen. So I think I agree with Isaac, very surprised by the extent of the hawkishness. While there was little comment around what we discussed before the press conference, the potential for US policy change to impact, there was a brief mention, but I think inherently in the statement around foreign risk, that was taken into account. So I'm surprised to the extent of the hawkishness.
Now, sticking with that foreign risk, one thing that also caught my attention was that Kganyago did mention that there's actually a possibility for global rate cuts to go higher. Now, following the Fed's meeting and just commentary around the Fed meeting a few weeks ago, we also heard Powell being a little more cautious than usual on the back of that higher inflation that they got there. They also had some weak job numbers, but this, of course, a short-term effect, considering that the jobs report came at a time where there was the hurricanes as well as the Boeing strike. From, what's been happening on the international front, the Fed in particular, have you started pricing in scenarios where perhaps there could be a hold or a rate hike moving forward from the global central banks, Isaac?
It will be about when these negative policies will be implemented and how quickly they will impact the global economy, the U.S. economy. As we're not going to see that immediately. It will take some time before we see the direct impact of higher tariffs, and therefore I believe that at least for the first half of next year, there should still be room for rates to come down. But central bankers are always forward-looking. Powell will definitely pay attention to what Trump is going to do, despite what he said at the last Fed meeting. And let me say, I want to see further rate cuts, because that will give us room, to get more cuts. If I can just go back to the SARB's numbers from today, the QPM now seems to be suggesting only 50 basis points in 2025 from 3 cuts at the time of the last meeting, and I'm a bit disappointed about that, I'll say.
Yeah, we were crossing fingers, crossing toes for, a dovish statement. But, one thing about Mr. Lesetja Kganyago, he will surprise you, Isaac. Johann, let's move over to risks associated with China now, right? So he did mention that, the Chinese economy is moving from a consumption economy, rather an investment economy, to a more consumption economy. How much of a concern has that been for you?
It's not a huge concern for me yet. The Chinese pension fund system, social security system is very underdeveloped, and that means Chinese consumers are more willing to save for their retirement one day than to spend. Chinese consumers spending as share of the economy is much lower than many, many other economies. And certainly they might be moving in that direction, and one of the mitigating policy measures that the Chinese authorities might take in the event of much higher tariffs on their exports to the US might be significant tax cuts to support consumer spending. But I don't think, in my opinion, it's that significant over the short term. I think that's a medium to longer term trend that we're going to see significant more consumer spending in China. But that highlights the potential risks down the line. I think the governor was perhaps too much focusing on medium to longer term risks.
Yes.
But what was clear is his firm statement that they're going to take this from meeting to meeting, that they're not giving any forward guidance. So I think that is playing out to the importance of data as it comes out. So if we continue to see lowish inflation numbers in South Africa, not too many highlighting the risks, if oil price remains well contained, if we don't have a serious drought, if the rand remains relatively stable, we are going to see further rate cuts early next year. And we'll have to watch, as he said, meeting to meeting.
Isaac, do you not perhaps think that maybe Governor Lesetja Kganyago was trying to just lower the market's expectations? Looking back, going into 2024 from the end of 2023, we had really high expectations of a rate cutting cycle kicking off as early as January, February. But that, we only saw that coming through to the third quarter. Do you not maybe perhaps think he's just trying to lower those expectations before markets get a bit too excited?
Well, I know Governor Lesetja Kganyago, and I can tell you that even Johann will say the same. He is a very straightforward man, and he is not going to go about beating the bush and create expectations that he has no intention of delivering on. So as he always stresses, the decisions are data dependent. The QPM is just a guide. So he will do what he feels it is appropriate to do at any particular time. He will not be looking forward on the decisions, at least. And on that basis, I don't believe that he was sort of trying to influence market forecasters like us in any way.
So remaining data dependent and not rather sticking to or trying to push or confirm a rate cutting cycle. He is remaining data dependent when it comes to that. Johann, we spoke about structural reforms and how that is needed to sort of boost the economy moving forward. We do have some new risks coming to the table on the local front. I mean, we have that water crisis, and we also have, construction mafia activity weighing on that sector. How much of a concern has those risks been to the growth outlook, I guess?
One thing in economics, it's not an exact science. So you get these ups and downs, but gradually we should be moving in the right direction. You're absolutely right, and that's what others are also highlighting. There are lots of risks around some of these structural issues. We're a resilient bunch in South Africa. We face a crisis and we sort it out. So the water crisis, we will gradually sort out. The private sector is very happy to get involved and try and help the public sector to sort this out. I was recently in New York at the SA Tomorrow Investment Conference, and I was surprised by the willingness of SOEs to accept the help of the private sector, and the willingness of the two to work together in sorting out SA's problems. And while it might be bumpy at the start, I think we're on the right trajectory upwards to a more sustained, better growth path than where we've been. It might not always be great. It might not always seem that we're getting there fast enough, but we're heading in the right direction.
You know, Isaac, in the last MPC meeting, Lesetja Kganyago highlighted slowing investment as a concern, contracting for 4 quarters. And, you know, the stronger investment performance is obviously a prerequisite for sustained higher growth in South Africa. So I guess we really need to get our house in order, right? We are slowly doing that, but it doesn't seem to be happening fast enough.
Well, it's, you know, I always say that an economy is like a 24-wheeler truck. It takes time to turn around and to accelerate. So at least we are seeing the economy moving in the right direction. There will be a gradual pickup in economic growth, in investment, due to, you know, all the positive factors that we are seeing right now. And, you know, I was pleasantly surprised by the 2% by 2027, because, you know, just with this hawkish statement, I was thinking that, you know, like the SARB was going to revise the growth numbers slightly down, but still not cut by 50 basis points. So, you know, I am encouraged by the affirmation of the positive trend in the economy, the rising confidence. All this positive momentum, you know, should push us to 2% and maybe 10% one day.
Let's talk about consumption for a second and, you know, just household resilience. We do have the 2-pot system in full effect with a number of withdrawals taking place. Let's talk about, let's say, the risk to inflation on that front, Johann.
I don't think there's serious risk of inflation from the 2-pot monies. What's been taken out so far has been around what everybody has been expecting. Part of that has gone into the tax payments on that withdrawals. Part of that has apparently, according to some surveys, gone into debt repayment. And thus the remainder monies is a very small percentage of annual consumer spending. So I think while we might see retail sales over the Christmas season and even Black Friday be relatively resilient compared to past years, I don't think in this weak inflationary environment that's going to have any significant upward pressure from the demand side of the economy.
What's your take on that, Isaac? As Johann mentioned, as we're moving into that Black Friday period, into that festive season period where consumers do a lot of spending?
Sure, I agree with Johann wholly. Very little demand pressure in this economy, but in the MPC statement, you know, I picked up a line where, you know, the MPC basically says more of the 51 billion withdrawals expected in the third quarter of this year, or at least since the withdrawals began, more of that is going towards consumption more than repaying debt. So when I read that, I thought maybe there's a bit of a concern that there could be slight pressure on spending, i.e. Demand pull inflation, but definitely that does not look to be the case in this economy, and it's very unlikely that we will see significant demand pull inflation.
You're right. I read the same article, Isaac, around the 2-pot withdrawals being used more for consumption than debt. I have about a minute to go, so I just want to get, let's say, your views around whether today's hawkish statement has changed some of your expectations moving forward. Johann, I'll start with you.
don't think so. I think for now we're going to see further rate cuts, but on that meeting-to-meeting basis. I think there's another 50 to 75 basis points in the cycle compared to the Reserve Bank's thinking in their models. But I think we're going to have another cut in January and one in March, at least.
All right, Isaac, we've got about 30 seconds to go. I saw you nodding. Do you agree with Johann?
Absolutely. We still see 3 more cuts in the first half of 2025. But of course, it will be data dependent. But I'm just hopeful that we will at least see the 3 cuts, instead of 1 or 2.
Alrighty, we're hoping for bolder and bigger cuts moving forward, just to give, consumers relief, because we really do need it. Gents, thanks so much for your time and your insights this afternoon. That was Old Mutual's Chief Economist, Johann Els, and Isaac Matshego, Senior Economist for Nedbank.